So, Grant, a couple terms that probably you don't hear every day are ILET or crummy trust. Talk about what the abbreviation ILET stands for and a little bit about those types of trusts.
Yeah, so an ILET is an irrevocable life insurance trust, and the Crummy Trust is similar deal. It was named, I believe, after somebody who had utilized this tactic. But the ILET is an interesting estate planning technique. It's kind of gone out of vogue now because the exemption amounts with estate tax are so high these days. But in the past, when it was lower, it could be a really important estate planning vehicle. And the basic idea is that you can place an insurance policy, a life insurance policy. It could be either on one grantor of the trust or two grantors of the trust, and essentially put that into a trust. It has to be properly done and properly maintained. But if that's the case, then essentially that death benefit that pays out for that life insurance trust is not subject to estate tax. And so that's really the main benefit. Again, it's not used quite as much because the exemption amounts are so high, but it has been, and in certain circumstances can still be very useful. One of the things that I think about is, what about an estate that has a lot of very illiquid assets? What are you going to do with those assets when it's time to administer the estate? Because you've got costs that need to be paid, assets that need to be distributed, but you've got these assets that are hard to become liquid. And so you might talk a little bit about how the ILET comes into play in that scenario.
Yeah, absolutely. I agree with what you said. I think, we see these less commonly now with the higher exemptions. They were utilized a lot more historically and may come back again at some point. But you're exactly right. I think it could be a useful tactic if the bulk of your estate was, ranch land, real estate, and you didn't have a lot of liquidity to pay attorney's fees, CPA fees, and the big one, which would be estate taxes. Typically, if you do have a lot of real property, at your time of death and not a lot of liquidity, you can sell the real property to generate some liquidity. But you never want to be forced into a situation where you're having to fire sell your investments, your ranch land, your farmland. So these trusts can provide a source of liquidity in that when you pass, that death benefit pays into the trust, at which point the trusts are often written with provisions to where they can make loans to the estate to provide liquidity, at which point you can take your time, maybe eventually sell some of that real property and pay the trust back. But it is a great tool to provide liquidity in the form of a loan to the estate. I wanted to also hit on, as you mentioned, most people are aware that, typically the death benefit of an insurance policy is not taxable for income tax purposes, even if you own it outright. But that death benefit is generally included in the estate for calculating estate taxes. So owning it in the trust pulls it out. It excludes it from the estate for that calculation.
And that's really the end goal, right? We want to minimize, the estate taxes owed while maximizing the benefit that pays out.
Yeah. I think another nice benefit, typically, if you're putting this into place, you do have a taxable estate most often. We didn't really hit on the mechanics much, but typically once the trust is written, the life insurance policy is funded, the grantor will make gifts to the trust annually, generally annually, and then those gifts can be used to pay the premium. Yeah. You mentioned the crummy provisions. Right. The way that those laws are written are such that is a gift it is a present interest gift, because the beneficiaries typically have a window of time during which they could pull that liquidity out of the trust, which not advisable, but because it can qualify as a present interest gift, some estate planning tactics would be to gradually, it's just another way to lower the value of your taxable estate through those annual gifts, especially if they're more sizable in nature. Keeping in mind there is a limitation to that annual exclusion amount.